And I will mute myself.
Okay. Well, hello, everybody. This is Shelley Hagan, here with my good friend Ken Chung to talk to you this evening. Ken and I are here this evening to talk to you a little bit about RSP investing with real estate. We'd had some discussions with Dave regarding real estate investing and what we've been working on, different projects that we're working on, and we've had a really good discussion about putting together deals and different opportunities with real estate. And it came to our attention that perhaps we should do a couple of webinars and talk about different strategies to help people that are maybe interested in investing, and give some ideas and maybe answer some questions and some opportunities. So we decided we'd start this first series on using RSPs and non-traditional forms of financing to help with deals. So Ken and I just thought we'd have a little discussion about that this evening. Ken, is there anything that you want to add to that?
Nope, you covered it all.
Okay. Let me just, okay, I'm just trying to get my presentation moving. There we go. So we'd like to welcome everyone. Thank you for joining us this evening. This is going to be taped and put up and make it made available to you afterwards. So I just want to, first of all, we're going to be talking about RSPs, but I do want to let everyone know right up front that we are not financial planners. We're not accountants. We're not tax advisors, lawyers. We do feel that it is important that you would talk to industry professionals about these things that we're going to talk about in the webinar this evening to get the proper advice to help you as you move yourself forward. So as I mentioned, my name is Shelley Hagan. I live in Calgary, Alberta, for those of you who don't know who I am. I've been a real estate investor since 2001, going on 18 years. I can't believe it. I used to work for the phone company back in Regina, Saskatchewan, and I started my little adventure in real estate investing back then. And somewhere along the line, Ken and I met up and started doing some investing deals and stuff together, and we've become really good friends.
That's what I call
Ken
the
and his
wonderful
family.
Winnipeg years.
The wonderful Winnipeg years, exactly. Now, that was an adventure in real estate investing. So a few years back, I moved to Calgary, and Ken and I have done business together in a couple of different provinces now. And so we just work well together. In fact, we actually worked together and co-authored a book back in 2015, which was a lot of fun, called The Dream Makers. And so we've known each other for a long time, and we just have a lot of respect for Ken, and we have a lot of fun working together. So we spend a lot of time working with other people. Both of us have been coaches and trainers and mentors, and we have worked on a variety of different kinds of real estate investing over the years, from residential, commercial, private lending, you name it. I've invested in both Canada and the United States extensively since about 2002, 2003, when I started investing down in the United States. So we've done a wide variety of things. And we often talk to people about how do they get started? What's a good way to get in? How can they get in and take advantage of, a non-traditional income stream, helping them expand their RSPs and their retirement plans and the funds that they're going to have available for them and their families as they go forward.
That's what I get a lot of questions on too, Shelley, right now, especially since this time of year, everybody's put all their money into RSPs because they want to max them out, but they know they're not going to get great returns out of them, so they want to figure out how to capitalize on them. That's why I thought this was a great time to do this. We can share some of the information, and they can, at that point, make some educated decisions and do a little more research on how they may want to diversify their RSP portfolios.
Exactly. And as you said, it's a perfect time of the year because RSPs are kind of front of mind right now because we just went through that with, tax season, right? So some of the typical things that Ken and I run into when we work with people who come to us and, ask us questions because of the experience that we have, they're always worried about, are they going to have enough money for retirement? Well, as we all know, where people are living longer, and people are probably going to be healthier when they get into retirement. May not want to retire as early as they planned on, or if they're going to, they want to certainly travel and do a lot of things and be a lot more active than other generations have in the past. And so that is a concern, because we know that there's only so much money that the government's going to have. And everybody's worked, for 30, 40 years to build up a retirement of some kind. And is it going to be enough to, get us through into, our later years?
That's what most people are seeing right now with their pensions that they're getting from CPP. Is they're realizing that even though they, back in the day when they thought they were contributing enough and through their jobs that it would be enough for them, the amount of return from them has not gone up substantially compared to the GDP or any other rate of inflation. So they're so far behind, if that's what they're dependent upon, that they don't know what else to do. Whether they use the equity in their home or whether they use their RSPs to add to that and make up the difference, if you will. Most of the time, it's got to be a considerable difference.
Well, and that's a very good point, too. And also, when they're talking about looking at their current portfolio, it is a bit misleading when you actually sit down and figure out the numbers, too, because you think you're going to have something that is going to be long-term sustainable and that you're getting a certain return. But when you add up all the fees and everything that's in those mutual fund portfolios, you're really not making as much money as you think you are. And then there's things that happen in the market that can completely turn your portfolio upside down, where you have little to no control over it, like what we saw in 2008, right, Ken? I mean, the markets just took a dive, and some of my friends lost in between 30 and 40% in their mutual fund portfolios. And those are things that we typically don't have control of. But there's things that you and I do with our investments that allow us to have a lot more control over where we're at and what we're doing.
Having those RSPs or TSFAs or wherever you have them being self-directed gives you the freedom to control your own destiny with them, as opposed to having somebody else doing it who's taking a fee regardless of the rate of return they get you.
Exactly. And so we always talk about, what's our rainy day fund? And now we have a different slant on it. It's like, how do we take your rainy day fund that you think about and turn that into an any day fund? So, and bring you into the world of passive investing as real estate or as investors, and look for opportunities that can, give you a plan B. Because as we talked about, the government only has so much money. We're only going to get a certain amount. And the amount of money that we're going to get is certainly not going to be enough for anybody to live on going forward with the rate of inflation and everything that's happening. So we're here tonight to talk a little bit about the plan B, and, talk about what we consider one of the best kept secrets in the financial industry. It's what, the banks and everybody else doesn't want the average person to know about, is how you can do things and take more control yourself. So we want to help you become the CFO of your own investment portfolio. And that's what, Ken and I do on a regular basis for people that we work with. And so a lot of people don't know that they can use their TFSAs and the RSPs to invest in private deals such as real estate investing. Now, we're primarily real estate investors, but we do a variety of different things as well. But we real estate's our primary occupation at this particular point in time.
And working with the funds like this, whether they're coming from a TSFA or a RSP, basically working with our private joint venture partners as the lender. And as you know, as private lenders, you're more flexible than, say, a conventional bank, and it's far more attractive to do so. In fact, that's why most people even get a better rate of return than a bank gets on a mortgage rate.
Exactly. And that's where, with the real estate advantage and turning your RSPs into an RSP mortgage can help you just, take your portfolio and grow it way differently than you planned on before. So typically people think about RSPs with things like stocks and bonds and mutual funds, GICs. Some people, know that they can do gold and silver, but majority of people don't understand that they can do mortgages through their RSPs that are secured by real estate. And so you have, bricks and mortar buildings that you have your investments with, instead of some, startup company that would be, internet based or something that you don't really know what they own and what it is that they do. And most of these investments are set up in a certain structure that would be what we consider a self-directed account. We're not going to go into, the semantics of exactly how to do that, because we don't really have time this evening, but we just want to give a bit of an appreciation.
And you can always reach out and get more details if it's of interest.
Absolutely. Absolutely. So when we talk about RSPs, we actually are referring to a variety of different things that are available. So your typical registered RRSPs, and what a lot of people don't realize is that you can use your LIRA accounts as well. So when I left the phone company, I did decide to take my retirement savings with me, my LIRA, and I was able to turn that into a portfolio and start lending out money through there. You can also use RIF. You can use your RRIF, Registered Retirement Income Funds. And of course, this also does apply to the tax-free savings accounts, which a lot of people don't think about as well, that you can use for real estate. And the very similar processes for TFSA as it is for your RSPs.
That's right.
So basically, kind of what you were talking about earlier, Ken, was the RSP holder becomes the bank. And who doesn't want to be the bank? I mean, the bank makes lots of money. All you have to do is look at, TD and CIBC and see what kind of returns they have every quarter. I want to be the bank whenever possible. A couple of reasons. I think really with the changes that have been made in lending in our country with traditional lenders, it's really making investors and other household owners look at non-traditional ways of doing things. And we've seen that happen in the United States after the crash in 2008. The private investor pool of investors has grown exponentially. And I really think that in the future, this is where money is going to come from. The banking systems are changing dramatically. And I don't know how they're going to evolve to keep up with what the community needs. What do their clients need?
When we talk a lot about these things, people don't realize that a lot of our private money is being used now. When you look at people who are putting their money into REITs and other funds, they're putting them into mortgage funds, and they're allowing these people to basically lend it out as if they're the bank anyway, giving a better return than what a bank's giving you, but definitely not what they could be getting on their own if they were being the direct. So you're cutting out the second and third middleman by doing your own mortgages through your funds.
Yeah, and that's a very good point, because most people don't even think about it that way, right? Because most of us have, gone through the process of getting our own mortgage to a traditional lender and not realizing that there's other options that are out there.
Yeah, so, I mean, Royal Bank even sells a lot of their mortgages to the private funds, and they manage those monies for them, so the lenders aren't really any to the wiser about it, if you will. But they create the mortgages and then they sell them, and a lot of them are to REITs. They're investment funds that are put together just to do mortgages, and they're taking their fees too. So a REIT has to be responsible to the shareholders and as to how much return they're getting for their money. So whether you're at the bank, a REIT, or you directly, what's the difference?
Well, that's a very good point. When I used to be on the board of directors of the credit union, I was surprised, that the banks actually sold mortgages. That was years ago when I was a member. And, they need to do that because they need to create churn and get their money working for them in different ways. So why don't we take advantage of that as, citizens of this country and start doing the same things that the banks are doing, taking control of our own stuff. Now, when we're talking about, taking control of it, we do need to make sure that we're setting our portfolio up with the right groups that can help us too. So there's a group of trustees in Canada that can help you administer the process. And it's, it is important that you do have somebody that understands this whole thing, and we're going to talk a little bit about that. I have another make reference to it on a slide in the future going forward here. But there are processes in place that are managed by Revenue Canada's Securities Commission. So you do need to adhere to those things as going forward. So proper education and due diligence is important to make sure that you have good long-term steady growth and good solid net returns on your investment, is just like anything when you're going
the
right?
nice part, whether they're short-term or long-term mortgages, it doesn't really matter. You want to make sure that you're following a process that's going to be beneficial financially across the board. I mean, I've seen people that have been able to take their RSPs, what they started with, and get 50%, 100% return on them within a few years, so that they're able to grow that wealth within the RSP and not pay tax on it.
Exactly, and that's the great advantage of it. You don't have to pay the tax on it until when you get at some point in time when you actually start to take the money out as income in your retirement. So you can build up a large portfolio during that time. When you're using your RSPs too, we do want to clarify that the RSP itself doesn't own the real estate asset. They own the paper, the mortgage. So you're actually becoming a portfolio lender rather than an asset holder, as such as owning the actual building in your portfolio. So it's a little bit different mindset, right, Ken? You have to kind of think about it is that I'm, buying and selling paper. I'm not necessarily buying and selling the building.
Right, absolutely. What's interesting though, when we talk about exactly that, having that portfolio within the RSPs, I started seeing with the new rules, people actually having to start drawing out of their RSPs, because they're getting closer to 70, and there's the new rules where they have to start drawing out or they're going to be taxed on it anyway. And so they're starting to take those funds, putting them into their TSFAs and their regular bank accounts, and using those as private funds without having to actually go through their RSPs anymore. So they're diversifying their portfolio, even though they're mandatory, be mandated to draw their money out.
Well, and that's a good point. Now, you can take your TFSA and set it up the same way as an RSP with a trustee. And the trustee then, allows you to write mortgages within your TFSA. And again, now you have all that money coming in there, all that income coming in, and it's completely tax free. So it's a great strategy to be using as you move forward. And at a certain point, most financial advisors do recommend that you stop investing in your RSPs anyway and start putting that money into your TFSA and taking advantage of that wherever possible. And looking for investments in your TFSA that give you better than average returns, which is kind of what we're talking about here with the RSP mortgages and the TFSA mortgages.
Yeah.
So the one of the things that when I first left the phone company and I had this portfolio that I took with me was, okay, what am I going to do with my investment portfolio, or with my retirement portfolio, my LIRA? And I was trying to think of some way that I could buy real estate with it. And I realized that I couldn't use it to buy it myself, but I could lend it out to other people. It was such a aha moment for me. And but we did have to learn, what the rules were. How could you manage this? So it has to be done as an arm's length mortgage. And at first it took a little while to figure out, what was that all about and what were the rules and restrictions around that.
That's where you get the benefit of working with the trustees too, because they'll help you and guide you in that process.
Exactly. Totally. They'll explain to you when you can do it, when you can't do it. So the money is that's held within the RSP account is lent out through a third part to a third party through an arm's length mortgage. So you can't actually lend it to yourself to buy revenue properties or to a company that you control, but you can lend it out to somebody else to buy a property in their company or in their personal name, and you still get to reap the benefits of a great return on that investment.
Absolutely.
Now, traditionally, when we got into this, I started lending out. And what did you start doing with yours? I know you've used yours for investing as well.
That's right. I was able to draw the money out back in the day. It's changed a bit now from then, but you're able to draw out a loan against it, and it had to be secured by a bond in order to do so. And then I was able to actually directly use the money myself. It was a unique process, but CRA's obviously put a close to that now. So
Yeah. So now it has to be secured against real estate. And most people do lend out as second mortgages. However, you can definitely lend it as first mortgages. And both Ken and I use first mortgage monies from RSPs to do things like fix and sell properties or buy a lot, with an RSP mortgage that we can then develop it into something else. There's a whole variety of different strategies that you can use. So
right,
it
we were
can be
looking.
done as a first mortgage as well as a second mortgage.
Right, earlier last year, we were actually looking at a property here in Kelowna to do just that. It had a house on it, but we were going to demolish the house and subdivide the property into townhouses. And in order to do that, you need to come up with most of it in cash because the bank's not going to want to fund it more than 50% on the vacant land. So it was way easier to work with the private lender we were going to deal with and put them in as a first mortgage on the property so that we had the ability and the freedom to work with that first mortgagee or mortgagor, and not have to deal with the restraints, if you will, of the bank. So they knew what we were doing and understood the process of bulldozing it and then putting in the plan to stratify and build the townhouses and then sell them off. And with less restrictions, it was worth it to pay a little bit higher premium on the interest rate, giving our investor a way better return on their money, which they were really excited about.
Yeah, exactly. Very good point. And it is there is a bit of an onus on the investor to do some of their own due diligence to understand what the investment's about, and work with the people that you're going to that are looking to borrow your money so that you have a good appreciation and feel comfortable with the whole thing going forward.
Yeah, absolutely. You always want to do your due diligence to understand the project. And even if you don't understand real estate investing 100%, you want to make sure that you're working with investors who are willing to share that information with you freely so that you can be as educated on it as they need you to be and as you want to be, because you don't want to get involved in something that you don't really understand. Yes, being a bank and being able to lend to the mortgage is great. And if you understand the simple fundamentals of the development, whether it's well, buy a house, we're going to put X amount of money into rehabbing it, and then we're going to sell it. That makes sense. Doing a subdivision and taking a property and cutting it in two and putting two houses on it and selling it, that makes sense. But when you get into doing a bigger thing that's for example, we were looking at that project for do 132 units on a subdivision. That's out of some people's understanding of the realm of knowledge. And anybody who's wanting to work with you deserves the right to be educated on how that process is going to go. Maybe not as in detail, but to understand the fundamentals. You do steps A, B, C, D, and this is our expected outcome.
Right. That's a very good point. And as we were talking about, you can get way better returns typically doing this kind of investment than you would if you were putting it into a regular, mutual fund. And it depends, though, on the type of investment. So each one is a little bit different, and it depends on the project. If you're going to get into a first mortgage and you're going to lend it out for a longer period of time, then you're not going to make as much interest. It's going to be higher than what traditional banks are lending, but it's not going to probably be at 12% unless there's some reason for that. But usually your higher returns, 8%, 10%, 12% or higher, are usually over short-term, fix and flip, land development projects where you need to get in until you can get your financing in place, something like that. Not every project can sustain a 12% interest for forever. So it depends very much on the type of investment it is.
Absolutely. I mean, geez, I think I paid on the Winnipeg project I did one at short term. It was close to 30% annualized return. And what I mean by that is it was a 15% per annum, but because we were in and out in less than 6 months, their real realized rate of return was actually 30%.
Right, exactly. And that's, typically we can give those kind of returns on things like the fix and flip and short-term, in and out projects. It ends up being, way higher than what we initially intended. We usually say, maybe 15%, and then in the end it actually turns out to be 30 by just the way the project worked out.
Right.
So depends on the deal. So, if you're sitting there and you're looking at this and think, well, okay, how do I get involved and what do I do from here? How do I get this whole thing put together? Well, really, if you're interested in doing that, then you decide if, is it something you want to do, is to put your retirement portfolio into a non-traditional investment. And, nothing is secured 100%. Even if you're investing in mutual funds, the stock market is going to go up and down, as we've seen, and can be very volatile. If you invest in real estate, there's trends in the real estate market as well. But when you invest with things like real estate, you still have the asset that the mortgage is attached to that you can go back on, versus the stock market, and all of a sudden the prices fall through the floor and you don't know, what Google or whatever is going to be worth in the future. So you do need to sit down and figure out, is this something that works for you? Because it's not for everybody either. Not everyone, wants to do this. And there's pros and cons of each one of those things, right? Ken, you really need to sit down as a family and decide if this is something that you think is going to work for you.
Yeah, does it fit into their financial plan for their, their future and their retirement? I mean, some people may be close to retirement, some people may not be anywhere close to retirement, but they know that they have options that are available to them that could expedite that process.
Exactly. And to sit down and figure out, what are the rules and laws and regulations you need to be cognizant of, and how does the whole arm's length mortgage work, so that you have a good appreciation before you get started. And again, your trustee can give you really good counsel on that. And, you usually have a lawyer that helps through the process as well.
Yeah, and even if they, like talking to you, it's easy for them to talk to you and connect and ask you questions. And then, of course, they want to verify and make sure that the information that they're getting is correct. It'll help expedite their process and know what questions to ask by, say, talking to you first, for example. It'll give you a good idea where to go next with it, and the right questions to ask and probably more importantly, the right questions to ask your family to determine whether it's the right path for you guys to even consider.
Well, and that's a very good point. And I have those kind of discussions all the time with people that call me up because they know that this is what, I do for a business, full time. And they know that I work, with you and different people in this as well. So, and I'm very comfortable at, handling those kind of inquiries. People can call me at any time. I don't have, any concerns about that. I love to talk to people about real estate. It's just one of the things I'm passionate about. If I can help in any way, by all means, I want to do that. And that's, as well, there's other industry professionals that you might want to, work with. You might want to work with a mortgage broker. Maybe somebody that, has a REIT, real estate investment trust, or other investors. But certainly, Ken and I are here to talk to, for sure. And you need to determine, how active do you want to be involved in this, or are you, would rather just be an passive investor? Because again, it's not for everybody. Maybe you're really busy. You've got a great full-time job or a business that you run, and you love doing what you're doing, but you really have always wanted to get into real estate, and you just weren't sure how to do that, and you don't really have time to take on a whole nother business. So, maybe it's best to work with someone as a passive investor who's been doing this for a while. So as I talked about, finding a good trustee, most of us, when I first got started, I was with Investors Group. And Investors Group, I found out, didn't have a process in place to do the arm's length mortgages. So then I had to look at other options that were available to me. And so there's a few different trustees that are out there that you would need to, consider how to move your portfolio and set everything up. Who do you work with, Ken, for yours?
I do a lot with Olympia Trust, actually. I still deal with B2B Trust on some private mortgages as well.
Yeah, I did B2B Trust and Raymond James
Hmm.
myself. At the time when I started this when I was in Regina, and I didn't know about Olympia Trust till I moved to Alberta, but they do business now across Canada. And their B2B Trust, Olympia Trust, are some of the bigger ones in the country. And they're all, financial institutions that are registered with the Securities Commission, etc. They're very, very knowledgeable, and they're very good to deal with.
And very,
And
really important for people to understand in that process is that they're a business too, and you want to make sure that you're understanding what their fees are, because there are fees attached to them to do that for you.
yeah, a very good point. Very good point. Need to understand what those fees are and how that applies and when that comes into, the whole situation. And are there some of those fees that you can pass along to the borrower as well?
That's right.
The, the trustee is set up to help you with this process. That's what they're there for. They will administer the process to make sure that the arm's length mortgages are handled appropriately, to protect the investors as they go forward. They work with the lawyers because we do need to make sure that everything is registered appropriately. If they will make sure the paperwork is done the way it's supposed to be done to protect you. And then, of course, everything shows up on your financial statements from the trustee, and you know exactly what's happening with the mortgage. You can see the mortgage payments on your financial statements, and it just shows up as another asset.
Yeah.
Instead of a mutual fund, you now have a mortgage fund.
And that comes down to building your power team too, right? A good power team is invaluable. I mean, I remember closing out a fourplex that we were going to do a rehab on, and then stratify and sell. We actually were trying to do this over Christmas, and the mortgage broker had made a few errors with the paperwork for the lender, and we were going to lose the deal and our deposit. I think $78,000 at the time.
Oh,
If we
yikes.
couldn't close, so I paid a private lender half a million. I think I ended up paying him a $7,000 fee, as well as his interest rate with a guarantee of 3 months interest. It was a 12% per annum, but a 3 month guarantee plus the $7,000 fee for 10 days for his money.
Right.
It was a
Yeah,
huge return, but I would have lost 78,000 plus the return on the project itself. So it was well worth paying for sure. Yeah.
absolutely. Absolutely. I'm just in the process with a deal with some clients too, and we need some private investor for a short period of time. We're willing to pay them like $7 million for having money for less than a month, and that's pretty significant for them to get me a couple pieces of paper. Really, is all they're going to be doing.
Yeah, as long as the math works, it makes sense. I mean, you know,
Absolutely.
it's really important. Math has to work for
The
both sides.
very absolutely for both sides too. The math has to work for certainly the borrower who's getting into the project, but if the math doesn't work, then you as a lender are put at risk. So you need to make sure that it works for both sides
That's right.
going forward. And then, so as we were talking about power team, and I mentioned the lawyer handles the paperwork with the trustee. The trustee sends the mortgage documentation to the lawyer. The lawyer makes sure, the borrower comes in and signs all the paperwork. So I would go into my lawyer's office, sign off on all the RSP mortgage documentation. They register the mortgage on title. I get a copy of the title too, so I can see that the mortgage is registered properly. I want to make sure that it is secured against the property because I want to protect, the investor that's investing with Ken or myself or whoever. If need to, they get title insurance. You want to make sure that there's property insurance in place and that the lenders are all named as payees on the insurance. So another way to protect everybody that's involved as you go forward. So we're getting close to we want to leave some time for question and answers. So just in summary, I would say, basically what we've been talking about here this evening through our conversation is, do some due diligence, do some research, um, talk to some of the trustees and find out, what it's going to take to make this happen. You want to find experienced people, investors and lawyers, etc., that know how to do this. There is a great book that was written a couple years ago, but it's still pertinent. It's called The RRSP Secret by a gentleman named Greg Habstritt. And it's a good book. It talks about, what the industry doesn't want you to know about RSPs and why it's a good idea to take control of your own destiny and just like we've been talking about here this evening, and do your own mortgages yourself. Anything else you want to kind of add regarding kind of summarizing what we talked about here tonight, Ken?
It really does come down to get to know the people you work with, whether they're your power team or the investors. People ask me why I work with you all the time on different projects, and it's because we have that relationship, that trust. I understand what you do. I understand how you do it, and the things that I didn't understand, you're happy to share with me, and vice versa. That's where I've benefited a lot of working with a lot of private money over the years. That's how I built up everything I did when I did it. And people didn't want their money back because I gave them such good returns. But at some point I didn't need it anymore. So it was hard to say, well, here's your money, but I don't want it, And I get that, because I think back in the day there, I was giving people 15 to 20% return on their money per year, and they enjoyed getting that money, but they didn't want me to stop. So that's just how I ended up growing as large as I did, as fast as I did, and getting into bigger things, bigger projects, the storage and the land development stuff, because I had too much money to work with. And that's a nice problem to have, I guess. But things have changed a bit. So it's a matter of making sure that you know who you're working with, what their resume is, their investment resume, as well as the people that you deal with. Not all lawyers are as well versed in dealing with private money. A lot of them, they might do a lot of conveyancing. They might do residential mortgages on a regular basis, but they really don't have that much experience in dealing with RSP mortgages, or they don't have experience in structuring the deal between the investor and the lender, and because that can change considerably depending on the project.
Well, and that's a very good point. And you got to feel comfortable with the people that you're working with, and feel that you can trust them, and that it's someone that you can work with ongoing. Because you want to have a successful relationship that goes on for multiple projects, probably, if everything works the way that you need it to work going forward. So we've got a little bit of time here. I'd like to throw it open to questions. Does anyone have any questions that has joined us? You can unmute your microphone and ask us anything that you might have, or you can type it in the chat box.
And if you're not sure where your microphone is, if you take your mouse to the bottom of your screen, you'll probably see a bar that pops up, and you'll see mute on the left, or a chat screen where you can type in.
Yes.
Okay. So, hi, Shelley.
Hey, Pauline. Good to see you.
Yeah. So no real question. I myself don't have RSPs, but I have friends who have been wondering what to do.
Right.
And so I thought, okay, your timing was pretty good.
Okay, good.
You've been very, very clear in your explanations, right? I can't think of anything to ask right now, but certainly will be taking this information to my friends. And I've got your contact information.
Yes.
Get them to direct it to you.
Okay, well, great. I'd love to talk to you if you have any questions about anything, or even if you have some of your friends that would like to get on a call with us together, we could certainly do that as well, for sure.
That's one of the nice things about these, or Skype. You can all video conference in and see each other.
Yeah, absolutely. And I'm going to put up my contact information at the end here as well, for sure.
Perfect. Thank you.
All right. No, it's great to see you again. It's been a while since we chatted.
It's been quite a while, yeah.
Yes. Good to see you're still doing real estate. That's awesome.
Yeah, thank you.
Does anybody else have any questions? No, at this particular point in time. All right, well, oh yes. Hi, Kelly.
Hi.
How are you doing? Good to see you.
Good to see you too, Shelley. Thank you for the invite on the webinar. One of my questions you had mentioned is if you want to be active or passive. Sometimes people want to be passive because of time commitments elsewhere, but they definitely have the interest in real estate. What would a passive investor look like?
Well, it's a very good question. Usually with passive investors that I work with and Ken and I have worked with, it's typically somebody that would come in and lend us some money to get working on one of our projects. And we'd set up some kind of a payment structure, whether it be a one-time payment if it's a short term, like fix and flip kind of deal, or if it's a longer term, quarterly perhaps payments or something. And we keep them apprised of what's happening with the project, but they're not involved in the day-to-day of the project because they just don't have time, and they really just want to kind of let the project go as it needs to, and just keep apprised of what's happening, and at the end get paid whatever they need to get paid. And they just want to keep rolling their money and turning their money as many times as they can to make a decent, better than average return.
Mm.
So that's a typical kind of passive investor. Ken, do you have something you want to add to that?
Yeah, the other one, well, we did a couple others too, Shelley, where our investors were passive. And what I meant by that is that they weren't hands-on on a day-to-day operation, where they popped in to see when we hit certain milestones. It's like when we were doing the project at Winnipeg and building the storage facility.
Yes.
Our investor there was out of Vancouver, would fly out, flew out when we took possession of the building, did our walkthroughs as our plan to develop and build. And as we got most of the structure done, and as we were putting things in place there, he'd fly out, a couple times just to see how the progress was. It was important for them to understand, and we wanted them to feel welcome to do so at any time. And it wasn't, ever something where it was too much. It was just as much as they really wanted to be involved at a certain level. Passive can be, kind of check in with you and just get a report every quarter, every month, depending on what the nature of the project is. If we're going to do a quick fix and flip, there really isn't a lot of time in there, so you're usually in and out really quick. And a passive investor would, at that point, just be watching just to see the transactions happen as they do. Other just say, okay, pay me at the end, and we're happy.
Well, and that's a very good point. We invite the investors to come out as much as they want to, too. If I'm, doing a fix and flip, I like the investors to come and see what it looks like when you first get started, when it's the little diamond in the rough and it's, smells like cat urine and everything that's going on. And then, we want them to come out at the end for sure and see what the finished product looked like, because they contributed to the success of that project by being an investor and coming in with us. So we want the investors to come out and be as involved as they, want to be and need to be, because we want them to see, how they contributed and how well it's going.
It's a good thing you brought that up. When I started doing that in Winnipeg, I did have people that wanted to come out and see it. In fact, I met a lot of people on the plane to Winnipeg that said, okay, I'll come look.
Yeah.
And after doing a couple of projects, they were so comfortable with the process, they didn't want to do it anymore. So I'd have to find a new project or something different to be more creative to get them excited to want to come out.
Yeah.
So when we took an 8-unit apartment building and converted it, and or renovated it and got it up and made it a rental, and we're going to flip it and sell it, that was more exciting to them. So it's a new project. So you want to find different ways of keeping them involved, and that's It's a good thing to have that trust build up. At the same time, people's desires and needs to know changes, and I get that. I had one couple who I mainly dealt with the wife, and the husband was always out of town working. And then when he had the opportunity, he wanted to see us. So perfect, fabulous. Got time to come out and see. And it was nice to be able to share that without any reservations, and never really felt like it was an imposition on their part or mine to be able to communicate that.
Absolutely. Absolutely. Did that answer your question, Kelly? Did I give you some ideas? Okay, great. Great. So, do you have any other questions for us?
Another question. Investors, what do they come in at? Like, is there a minimum, maximum? Well, maximums.
It depends.
50,000, 100,000?
Depends on the project. That's a very good question as well. It depends on the project. Maybe you just need an extra 20,000 for the renovations or something if you're doing a fix and flip. Maybe you need 200,000, and not everyone has 200,000 in the RSPs that they want to, lend out. I have people that have 400,000 and 500,000 that they lend out on, buying a house here in Calgary, kind of thing. So it varies too on what their the value of their portfolio is. I don't like to take all of them, money. I would never take anyone's entire RSP savings as well. I always, say you should keep it diversified within your portfolio. If you're going to get into real estate, put it into multiple projects necessarily. So it very much depends on the project and the individual.
That's right. And you can, like, we've had instances where we've had 4 or 5 different people who a couple knew each other, but most of them didn't. And they all formed a group, a consortium, if you will, to jump in on one project to actually create the total amount of funds that were needed. And that was a relatively easy process to go through for somebody that's seasoned like Shelley and I. A lot of investors who would have no idea how to guide somebody through that process may not understand it, but it is actually relatively easy to do. So, Pauline, for example, you said you had several friends that have RSPs and were not sure how to do this type of thing. 2 or 3 or all of them could get together and actually participate on a larger scale and minimize their risk at the same time.
And that's a good point, because you can put multiple people together into an investment. You do definitely need to have the right, legal professional that can help you organize that, but there's ways to do it for sure.
Yeah.
All right. Any other questions?
Actually, one.
Oh no, you're limited, Pauline, to only one.
Yeah.
I knew a lot of what you were talking about before.
He's just kidding.
I know. It's great. I love your sense of humor. What geographic areas are you all working in right now, investing in?
Well, I still invest in Alberta, and Ken and I have been working together on investments out in the Kelowna, interior BC region. Yeah, Vernon, Coldstream, Kelowna. We've been looking around that area. And, I still do stuff in Phoenix as well, with my business partner, Carol. It depends on the area, depends on the project.
Yeah, every market's a little bit different, and it can be quite volatile if you're, a lot of people get worried what's happening in the market today, for example, with the foreign buyers tax and the vacant ownership and all that kind of stuff. It can really play havoc on a market. And so, for example, something in Vancouver, unless you were doing it all the time in Vancouver or dealing with somebody that did it all the time in Vancouver, you may want to be in and out a little quicker, right? You might never to say it's a bad place to park your money that way, but it might be something you say, okay, well, that project might seem a little too long, too unsure of where that's going to be. Where if you have something that's a little more steady, Eddie, consistent, you may say, okay, I can see that being a better project. It might take a year or 2 to get to where it wants to go. But I can see with the amount of information that's provided and due diligence that you have done that it makes sense for that marketplace, right? So that again only comes with the experienced consultative approach, whether it's from the lending side or from the borrowing side, to know that.
Right.
Okay, great. Thank you.
Okay, good questions. Does anyone have any other comments or questions, thoughts that you want to share as we go along?
I have a question.
Okay, good.
Is there a possibility, if a person was to get involved in this investing, to even do it, like I work a full-time job, plus I run my farm at home right now on my own. My goal is I would love to be able to have passive income coming in, whereas I'd only have to work maybe part-time at my job, have more free time to go to Alberta to visit family more often. Is there a possibility to get involved in real estate and work at it for the next 6 months, a year and a half to reach a goal like that?
Yeah, we'd certainly have to sit down and take a look at what, financially you would need in order to make that happen for you. And then, take a look at strategies to get a portfolio for you of either investments that you owned yourself or passive investments that you got into to help you with that.
That's right, because you want to make sure that you're, again, not putting all your eggs into the one basket. And that doesn't mean not putting it all into real estate, but putting it into different parts of real estate. It could be as simple as picking up an extra property or a condo that's going to give you a great return, or a duplex that's going to do the same. Or it could be putting in your own level of lending from 4 or 5 different mortgages that's going to generate that. The one thing you have to realize with the mortgages is that they do get paid out from time to time, because not everybody wants to pay that kind of money on a long term. When you're doing a lot of private money, they're usually less than a couple of years, because even though you might get, let's just say 12%, which is 1% return on your money, that's good return considering what other options are out there. However, that could stop after a year or two, and then you don't have that passive income at that point. So unless you're putting it repeatedly into other projects, you also don't want to be dependent upon having to put it out there into projects and maybe taking some unnecessary risk to make sure that you still have that passive income. And that's why we talk about diversifying that portfolio. And it really could be as simple as saying, okay, I don't mind taking that and using my profits from my mortgage money to go buy the house next door where I'm close and convenient, and I know that that's going to generate me an extra $1,500 a month passive income. That's okay to do that. But I always say use your profits from a project or from your investment to pay for those types of things. Everybody always asks me when I first got started, all I wanted to do was to buy a house to pay for my RV. And it was real simple. The RV payment was $300 a month.
Okay.
Or I could have put $30,000 out cash to buy it and not have a payment. But wait a minute, if I bought the house at the end of the block, that gave me $700 a month passive income, paid for the trailer. My money wasn't really spent. It was invested into a property that was growing in value. And after even paying the RV payment, I still had $450 passive income in my pocket. So that was a pretty good deal. Right. And then I just realized what it was and I multiplied it.
Perfect.
Exactly.
And if you don't know how to do some of those things, connect with us offline, and we're always happy to sit there and spend some time and talk to you about, like Shelley says, what your goals are, what you have access to, and how you can best achieve what is needed for you, because everybody's going to be a little bit different.
Absolutely. And that's what we're here for. And one of the things that both of us are passionate about is helping other people. And that's why we've been coaching and training and all kinds of things for years. And the people that we work with that come on with us as investors in our projects, some of it's part of an education process too. And we want to help other people be successful for their future. It's really what we're all about. One of our favorite sayings is, we can share knowledge. Knowledge itself isn't the power. It's applying that knowledge is the power. It's taking action after you've learned a few things. Yeah. We're kind of running out of our time here this evening. I know that I think we only had an hour to go forward. So I do have contact information. Again, we're very open to having a conversation. If you guys have any questions, or anybody that's listening would like to get in touch with us, by all means, please do. We'd love to have an opportunity to sit down and talk about, kind of where you're at, what are your goals, where do you want to go for you and your family, and see what we can do to help you be successful and work together.
Yeah, remember, every situation you get into, you want to make sure that it's a win-win-win.
Absolutely.
Never think it's going to be a win-lose, because it'll be unhappy, a bad experience, and not one that you're going to want to repeat. Exactly.
Very good point. All right. So I think that's probably about it. I think we're at 8 o'clock, or 1 hour is up. I think that Dave is probably going to stop the recording here. Oh, there he is. All right. Thank you very much.
That was a great presentation. And thank you, everybody that was on the call live. And if you have any questions reach out to Shelley, Shelley at shelleyhagen.com, or give her a call, 403-540-2668.
Yes, that'd be great. Love an opportunity to talk to you. Thank you so much for inviting us tonight, Dave, and it was good to have the opportunity to chat.
Yes, thanks for having me on, guys.
Yes.
Take care, everybody. Have a good night.
Okay,
Thanks for the
bye-bye.
questions, everybody. Have a good night.